It's Tuesday, January 27th, 2026, and right now, the entire strategic landscape is being rewritten. It all starts with a single investigation, and it's happening at the absolute highest level of a global power.
Those are the words coming directly out of Beijing, severe violations. We're talking about China's most senior general, Zhang Yuxia. He's now under investigation, and the allegation, leaking nuclear data to the United States. Look, this isn't just another corruption probe. This is a potential purge right inside a nuclear command structure, and that creates just massive, massive instability.
And that instability, well, that gives us the golden thread for our entire briefing today. Friction. Yeah, friction. From military purges all the way to contested trade routes, there's this new layer of, well, transactional, political, and policy friction that's connecting every single major event, both abroad and right here at home. All right, let's dive in. First up, the deep dive into geopolitical pressures. We're going to see exactly how this theme of friction is playing out in the international arena. And believe me, it's reshaping critical supply chains and creating whole new battlegrounds for trade.
Okay, headline number 1. Sanctions are completely reshaping energy security. Let's start with the oil supply chain. You know, for the last year or so, the big story has been all about cheap Russian crude. Well, that story is changing fast. And the reason? You guessed it, friction.
And you can see the direct cause and effect right here. On one side, you have Russian crude. Its share of our imports dropped 11% last year. Why? U.S. sanctions are creating what the industry calls rising execution complexity. Now, in plain English, what does that mean? It means the simple stuff, getting insurance for a tanker, processing a payment, has turned into a total logistical nightmare for Russian suppliers. And look who's jumping on that opportunity. Iraq. They're now supplying almost as much as Russia, and they're doing it by offering better credit and discounts. They're not just selling oil, they're selling less friction. So here's the hard close on this one. The game has absolutely changed. It is no longer about finding the cheapest barrel of oil. It's about building a supply chain that's resilient enough to handle all the financial and political friction that geopolitics throws at it. All right, next headline, U.S. tariffs versus the data center boom. Over in the U.S. market, Indian exporters are getting caught between two huge opposing forces. It's like a hammer and a magnet. You've got this tariff hammer coming down, and at the same time, a massive demand pull. 50%. Just let that number sink in. That's the tariff the Trump administration has imposed, and it's an explicit penalty for buying Russian oil. This isn't some abstract concept. This is policy friction, and it has a price tag. And here's what that looks like in the real world, 760 basis points. For a company like Sterlite Technologies, that 50% tariff translates to a 7.6% hit to their core profitability, their EBITDA. That is a massive chunk of their margin, just gone, wiped out overnight because of a policy decision made thousands of miles away. But here's the crazy part. At the very same time this tariff hammer is falling, there's this incredible opportunity. It's called the BEAD program. So let's do an anchor and twist. The anchor, the formal fact, is that it's a $42.45 billion U.S. infrastructure project. Okay, so what's the twist? In plain English, America is basically building the internet's superhighways from scratch. And that creates this huge, huge demand for the exact same telecom gear that's now getting hammered by those tariffs. It's the perfect storm of push and pull. So the hard close on this is simple, and it's critical. If you're exposed to the U.S. market, you just can't assume business as usual. You have to build operational hedges, because a single tweet or a policy announcement can literally destabilize your entire balance sheet overnight. Okay, so while the U.S. relationship is all about friction right now, the European Union, they're playing a totally different game. Our next headline, the EU sells stability as a product. They're positioning themselves as the antidote to all this chaos. So the European Council president is calling the India-EU trade deal a geopolitical stabilizer. Let's anchor and twist that term. The anchor, okay, it's a trade deal, we get that. But the twist is what they are really selling. It isn't just access to their market. They're selling predictability. They are making a bet that in a world this full of friction, stability itself is the most valuable commodity you can buy. But you know, while the EU is trying to sell stability, friction is flaring up in a big way in other cross-border deals. Let's look at our next headline, contract friction in cross-border infrastructure. And the Adani Bangladesh Power Agreement is a perfect case study. So this is what contract friction looks like up close. The accusation is that Adani Power priced their electricity about 50% above the market rate.
The recommendation from a government panel in Bangladesh? Renegotiate the entire 25-year, multi-billion rupee deal. That puts enormous risk on the table. But here's the hedge. Look at this. Adani is already planning to connect that same power plant to the Indian grid by May 2026. That is a textbook move to protect themselves from this exact kind of sovereign risk. All right, that kind of contract friction is just one piece of the puzzle. Let's pull back now from the geopolitical and look at the domestic front, removing to the undercurrents, the systemic squeeze. Because that same theme of friction, it's playing out right here at home, creating a squeeze from all sides. And this table really lays it out. Friction is tightening the screws from 4 different directions. You've got fiscal direction. That 4.4% deficit target means it's tougher for sectors that rely on government borrowing. Then there's audit oversight. Regulators are now testing AI to supervise companies. That means you need audit defensibility. Your books have to be so clean a machine can't find a flaw. Third, enforcement risk. The ED freezing nearly 2,000 foreign assets creates what we call clean title risk, a sudden danger that your ownership of something could be challenged. And finally, you have good old labor friction. With airline and bank strikes, service disruption isn't a what if anymore, it's a when, and you have to plan for it. It really is a squeeze from every angle. So it should come as no surprise that the markets are starting to react to all of this. Now we're looking at what's on the radar, market warnings. And let's be clear, these are not just numbers. These are warning signals. Just look at the vital signs here. The Sensex, down almost 2.5%. The Nifty 50, down over 2%. And what's up? Gold, up over 2%, hitting a record high. I mean, this is a classic textbook story. It's not random noise, it's a flight to safety. Money is running from risk and hiding in safe havens because of all this rising uncertainty. So what's the so what here? This is not just another volatile week in the market. This is the market finally digesting and pricing in all that systemic friction we've just been talking about. To see these numbers and not connect them to the bigger picture, well, that would be a critical mistake. Okay, let's bring it all home. Section 5, the synthesis, navigating volatility. The big question is, how do you operate, how do you win in an environment where friction is the main feature of the landscape? Here is the final verdict. For years, maybe decades, the name of the game was pure cost efficiency. That world is gone. That era is over. In today's world, a world defined by friction, the things that matter most are operational resilience and your ability to hedge against sudden, violent policy shocks. And to make this truly actionable, here are 3 things you absolutely need to be watching in the coming days. First, that Adani Bangladesh deal. Whatever happens there is going to set a huge precedent for cross-border contracts. Second, track the U.S. tariff rhetoric. Any new signal is going to hit export-focused balance sheets almost immediately. And third, watch India's budget release. We need to see if they confirm that 4.4% fiscal deficit target. That number is the anchor for how the market prices risk. And all of this leaves us with one final critical question, a question you should be asking yourself and your team. In this new age of friction, is your organization actually built for resilience? With diversified supply chains and real contingency plans? Or is it still built just for efficiency, perfectly optimized for a low-friction world that, let's be honest, just doesn't exist anymore?